Hello, everybody. This is Andre and Stuart from Evolutions, and today we're talking about possibly getting a mortgage in today's environment. Stuart, I know you had some questions about that. What's on your mind?
Yeah, so one of my goals of 2020 was to buy a home, as you know, I've discussed multiple times. And I actually started the process with my realtor, looking at locations where in Los Angeles I want to live. And the truth is, I was thinking, is now even the time to buy? You start thinking, oh man, price homes are going to come down. You hear terms like the interest rates drop down to zero, I heard. Can I even get a loan right now? Are realtors showing homes? Are the banks open for business? Are they focused on the PPP and unemployment so much so? I just want to know, is this a good time? Is the process the same? How has it changed? And just basically where to start.
Yeah, in terms of kind of answering those questions chronologically, in terms of is it a good time, it really depends on your horizon of what's going on for your kind of mid to long-term planning. Every consumer that I've ever talked to, we always start with the plan, what's happening in the next 5 to 10 years of your life. If you can truly understand like, hey, I'm going to be here because I have kids, I have family, I want to be in this school system. That's a time that, panic buying or trying to just get in with the Joneses isn't really too much of an impactful factor because you're planning for the long term. Real estate is a long term investment typically overall. If you're looking to potentially gain real estate because it's a flip right now, it's still an uncertain market. So you don't want to bet on kind of a process that you're unfamiliar with. Secondarily, in terms of the process hasn't changed regardless of coronavirus or any kind of different times. It's always going to come down to your credit, your income in terms of how much you can repay, and then lastly, the collateral, meaning what type of property are you trying to buy and how much money do you have to put down on it. So those things are always going to be consistent. The banks it's a case-by-case basis. Certain programs are going away, certain guidelines are tightening up. And then some banks have a moratorium in terms of if they're lending or not. However, that is putting a skew on the ones that are lending, right? Their business could potentially be booming because other investors aren't loaning out or creating new loans. So there is opportunity for some in the place right now.
Is there a different mindset between a first-time home buyer who I'm starting a family, I just got married, we're planning to have kids, we love the school district, our families are relatively close, versus somebody that's buying either an investment property, a true investment property where it's a second home, third home, or their mind says, I'm going to live here for 2 years and then get out and buy another one?
Without a doubt. Those are all kind of 3 different categories, right? So the first one, just in terms of largest barrier to entry, if you're an investor, your down payment is going to be dramatically different. Typically, you're going to need anywhere between 20 to 25% down payment. I mean, that may be achievable on some different areas, whether, the Midwest or somewhere else where the home price is a little bit less. But when you're talking about, hyper growth markets such as California, New York, places like that, a 20 to 25% versus a 3% down payment are drastically different. So that's right off the gate in terms of investors.
In terms of the mortgage business, how's an investor defined in this state? If you already own a residential property, then you're automatically an investor, or if I'm buying a vacation home, I'm not truly an investor.
Yeah, it's typically based upon what's your deemed purpose of that property. So an investor, really what it comes down to, regardless if you own a home or not, it's if you're going to live there. If you're not going to live there, are you going to rent it out, or are you going to be there parts of the year? So kind of working backwards, an investor, they're trying to buy that home so they can actually rent it out or try to flip it in a certain time period without showing proof that they're going to truly own or occupy that residence. Secondarily, you have secondary homes or vacation homes. Those have some requirements in terms of how they qualify. So they have a little bit less of a down payment, but you're basically, are you going to occupy that property for some portion of the year? And it has to be at least over 150 miles away from your primary residence. A primary residence, you're going to prove up that you're going to live there because of your employment, right? Like if you were employed in Los Angeles, California, and you say, I'm going to buy an owner-occupied residence in New York, the banks are typically say, prove it to me. What's bringing you to New York? You have an employment contract that states you're going to be there. what kind of history do you have from New York? If you can't prove that, typically there are going to be some questions that have to be answered to prove your occupancy.
Got it. Makes sense. And then you were touching on, you said the investors have to have a much larger down payment. What about your standard down payment for first-time home buyer or single-family home buyer?
Yeah, first-time home buyers, it's pretty unique. There's still programs that are available that you can get in with, with as little as 0% down. Actually, there are some kind of wealth builder programs out there. In addition to that, if you're a military veteran, you have a 100% financing program. And just from my opinion, over the last several years that we've helped out, the VA loan is always going to continue to be one of the best performing loans in America. You have that benefit. If you're a veteran, consider utilizing it. And then just other thoughts in terms of the mortgage and the real estate market. If you currently own a home and you're thinking about mortgage refinancing, there's some terms that have come to the forefront as of right now that you need to be familiar with. So they're forbearance, deferment, and postponement. So forbearance is typically when you have a mortgage and you're trying to offset those payments later on in the term of that loan. A deferment is when you're offsetting that mortgage for a certain period of time, but then it comes up. So for instance, you defer 3 payments on month 4 that you have to pay it. And a postponement is very similar to a forbearance where you're basically adding it to the end of your loan. The deferment is the least desirable of all those options. So if you have an opportunity to look at a forbearance or a postponement with your servicer, those are things to consider, just because most people, if they're already reaching out for help, they're not going to have those funds on month 4 that they didn't have on month 1, 2, and 3. And better yet of all, like the insider secret to this all is, if you have an opportunity before you choose any kind of option, whether it's checking it off on your mortgage statement or just quickly applying just because somebody else did it and trying to save some money, call your servicer, talk to the loan modification department, and ask them, what are your options? If you do have an option, the option that you should choose, just because it'll allow you to continue moving forward if you do have a refinance in place, is to say, can you mark on my credit report that my home loan has been affected by natural disasters? Literally, we're just getting that guidance as mortgage professionals and underwriters across the nation to say that that is allowable still, whereas a forbearance or a deferment or a postponement is putting a negative mark on your credit and actually invalidating your opportunity to do a refinance.
Good. For first-time home buyers, is that truly defined as the first time I buy a home, or is there a rolling clock? Like maybe that clock starts over every 10 years? Or, for example, if my first home was purchased as a married couple and then now, unfortunately, I'm divorced, now it's my first time buying, being the sole person on the loan, is it truly just you have a one-time to be a first-time home buyer, or is there some sort of – a birdie might have said something to me once.
Yeah, I think, really it's going to be program specific. So like the VA, if you've purchased a home with a VA loan and you're buying it again, you're only once a first-time home buyer. However, other programs available out there, it's typically a 3-year mark. So for instance, if you haven't owned a home in 3 years and you're going to buy again, you may qualify for a first-time home buyer program if you can show that you haven't had a history of a mortgage in the last 36 months.
Wow. Okay. Nice. One last final question. This is the easy one. What are the top 3 or 5 things I need to do, like a checklist to prepare to buy a home in general or specifically during this time period?
Yeah, I'd say, top 3. Number 1, double check your credit, see where you're at. And there's a difference between credit reports between annualcreditreport.com or creditkarma.com. When you're working with a mortgage lender, they have a different tri-merge that they're pulling. So number 1, check your credit. Number 2, get your documents in order. So get all your financials, W-2s, tax returns, any other kind of tax returns you're filing for self-employed businesses and stuff like that together. Get all those documents together. Number 3, meet with a mortgage banker and try to figure out what your options are and how do they coincide with your mid to long-term plan. And then once you get all those done and you get a pre-approval letter, number 4 would be working with the realtor to kind of understand your needs, right? Like if you have a growing family, if you're relocating, if you're trying to downsize, what those all look like, and then marry those options with the financial plan and see if they all make sense. I'd say that's the easiest way to plan for a mortgage and the right way to do things.
Man, I'm sorry. I got 2 more. This is good. So I have two more. I'm gonna ask them both, and you can. So I hear the term jumbo. What's defined as a jumbo loan? And then the other term. Well, let's just talk about jumbo loans first. What is that?
Sure. So there's a difference, right? Like conventional loans are typically loans that are serviced by Fannie Mae or Freddie Mac, or go up to a certain dollar amount. And then everything other than that, in terms of above that dollar amount, is considered a jumbo loan. So just hypothetically, like in LA, that loan amount is typically up to around $787,000. Anything below that is considered conventional. Anything above that will be considered jumbo. And why there's a true difference in those markets are, number one, the conventional markets have secondary sources that will buy those loans, such as Fannie Mae and Freddie Mac. Jumbo loans typically do not have a secondary market. So when lenders are creating those programs or funding those programs, typically the bank is funding those with their own reserves. So there's not as much of a market in that regard. Secondarily, it's really the guidelines that come with it. So for instance, maybe your down payments are a little bit less for the conventional programs. They're a little bit more for the jumbo programs. In addition to that, the guidelines. So for instance, you could possibly buy a home with as little as 2 months worth of payments saved. On a jumbo loan, some of these banks want a minimum of $250,000 saved. So there's a huge swing in terms of those programs, and they're typically defined by the loan amount of that particular loan.
Gotcha. Thank you. And then last question. So debt. I am not a fan of debt. So in my head, I was always thinking that I get the 15-year mortgage that paid off faster, or if I did get a 30-year mortgage, approach like a 15-year mortgage, so pay double payments. My question for you is specifically during this period of time, the COVID pandemic, and possibly going into some sort of like recession, what that looks like, especially in the mortgage industry. Are you still telling people they should do 15, 30? Is there a 60-year mortgage out there we don't know about? Like, what's the approach from that standpoint?
Yeah, the approach is always going to be personally, what are your objective for that term, right? So if you can define for me what you're going to do in the next 15 to 20 to 30 years, that's typically where we're going to start, really with where you're at and where you're trying to head to. In terms of making a choice between a 15, a 20, a 25, or 30-year loan, it's really just dependent on what you're comfortable making a payment for. So a lot of the strategies that we deal with right now is, number one, always trying to figure out the best mortgage rate that you can get for your personal situation. Secondarily, if that 15-year is a really, really high stretch for you as a personal kind of financing objective, we wouldn't suggest that. So it's great that you could get a lower rate with the 15-year fix. It's great that you'll pay less interest over the life of that loan. But if you can't make that payment, or you're struggling every month to put other necessities aside because of that loan, we wouldn't suggest that. So a way that we can still do that is you can take a little bit of a longer term, whether it be a 25 or 30 year, and take the payment that comes with that. So it gives you flexibility in terms of saving money. And then what you can do is add towards the principal. So you understand both payments. So you have a 30-year loan, but you understand the 15-year fixed payment. For every month that you can, make the 15-year fixed payment, and it'll still drive down the term of your loan and also the interest over the life of that loan. Then you also asked another question in terms of amortization. Typically here in the United States, the typical terms are 15, 20, and 30-year loans. There are other investors that have 40-year amortization products, but it will be a case-by-case process for those particular investors.
That makes sense. Good. Appreciate you throwing the word amortization in, because I certainly didn't use it, but I appreciate that. No, I'm good. I think I'm ready to go buy something.
Yeah,
we'll have a conversation off this video.
Yeah, I think the things to realize, just if you're looking at a mortgage and you're looking at an opportunity to buy or refi, just really track down what your plans are. If you have a significant other, or if you have a family, truly look at it as a collective experience to try to figure out where you're at right now and what you're trying to put together for the future. And don't let advertisements fool you, right? Like The other thing to really understand is read the fine print. You have other lenders out there. I'm not going to name any names, but they advertise nothing but rate. Hey, we have this low interest rate. We have this low interest rate. A lot of those times, these lenders are putting deceptive marketing practices to play. So they're advertising the rate, but they're not telling you the true cost. So for instance, let's just say an average interest rate is 3.5% or 3.25% on a 30-year fixed. Some of these lenders are saying, hey, we can get you 2.875% on a 30-year fix. Naturally, you're drawn to the lower number, but what they're not telling you and we're not explaining to you is if you look at the loan estimate, what they're doing is they're charging you multiple points. What points are cost to your mortgage. So if you have a $400,000 mortgage and it costs 2 points, it's going to cost you $8,000 to achieve that interest rate. Well, you got to think of that. When's that payback period of time going to be for that $8,000? Does paying that much to achieve that interest rate even make sense to you? And then what we always say, get a second opinion. Truly, look up people's Better Business Bureau scores to make sure you're not getting scammed. And look at the loan estimate every single time, right? Look at two factors. What is the rate, but also what is the cost of getting that loan? Definitely do that.
Oh, it's good.
Other than that,
no, thank you. Yeah, I'm going to play back this video, and then I'm just going to say, if you want more information from a guy like this, evolutionsapp.com.
Definitely. Whatever we can do to help you out. We have teams of advisors across the nation ready to go. We look forward to helping you guys out, make the best decision for your planning, and we're here to support you guys. So be easy out there. Take care. This is Andre and Stuart signing out. Thank you very much.
Thank you. And as always, when you're ready to schedule a consultation with the Evolution's team, it's as simple as downloading the app, which is available on both the Apple and Google Play stores. You can also find us on Instagram at Evolution's App or the website, www.evolutionsapp.com.